how to find and analyze a cash flow investment. And really, this is, if you've watched any of my previous stuff or attended any of my previous webinars, I'm always talking about passive income and cash flow positivity. I only focus on this type of strategy. You've obviously also got your buy and sell strategy, where you buy at a discount, you sell at a premium, you walk away with a nice healthy profit. This strategy is where your rent exceeds your monthly expenses and you walk away with a passive recurring income. So here's a quick example of what cash flow means. On the left, we've got our savvy investor, Sherry, and on the right, we've got our uneducated investor, Michelle. Now, they both are living similar lives, but one is living with a cash flow positive position, and the other one is living with a cash flow negative position. Cash flow positive, Sherry, on the left here, has a salary, same as Michelle, but she also has expenses that are less than her salary, and she's getting income from different elements. So she's getting her salary, she's getting rental, she's getting a side hustle. Versus Michelle, who earns the same as Sherry, but has exceeding expenses. She has lifestyle, luxury, she goes on travels. Now, what we can notice here about Sherry is that the inflow of money coming in, her salary, her side hustle, her rental income, is greater than the money going out of her bank account. So the inflow is greater than her outflow, meaning she's left with cash flow positive of 5,000 rand. Right? When you're looking at Michelle on the other side, even though she earns the same that Sherry does, she spends more than she earns, leaving her with a monthly debt. Now, it doesn't take a rocket scientist to know that at some point Michelle is going to run out of money. She's going to have to tap into very expensive credit card debt, and slowly but surely she gets into a cycle of poverty, which then turns into generational poverty. Sherry, on the other hand, if she keeps on this trajectory, what she's doing, she's running her life like a business where there's a profit at the end of the month. She can use that 5,000 Rand to invest in stocks, shares, bitcoins, gold, property, whatever it may be. Now, that's the concept of cash flow. When your cash flow coming in is greater than your cash flow going out, you're left with a positive cash flow at the end of the month. If you're like Michelle and you spend more than you earn, you have more cash going out than coming in, you're left with a negative cash flow. Now, that is the key success metric that I use when I'm analyzing a property investment. Okay? When you're looking at property, you've got a cash flow positive property. You've also got a cash flow negative property. Your cash flow positive property has income that is greater than the expense that that property generates, and you're left with a positive cash flow. Right? That income could be the rent that you charge. You could charge for parking. You could maybe have some advertising space. So if you could maybe have a billboard there that a company pays you 2,000-3,000 Rand to promote their products on, or you could even charge for storage. Your expenses are your levies, your bonds, your rates and taxes, your insurance, your provisions, etc. And then your cash flow is your profit. So if your cash flow coming in is greater than your cash flow going out, you've got a property asset. It's bringing money into your pocket. When you've got a cash flow negative situation, your income is less than your expenses, you're left with a loss. Right, so that's really the key success metric when I'm looking at a property investment. I want to make sure that number one, it's cash flow positive, and then number two, look at the return on investment to see if I can justify the risk that I'm taking on this investment. Okay, so let's look at a cash flow negative example. Okay, this is in a very nice suburban area in Cape Town. It's called Greenpoint. It's kind of like almost like a four ways, maybe a Midrand, maybe a let's see, like an Umhlanga. It's like that kind of, depending on which region you're from. It's quite an upper income area. Now, this is a 2-bedroom apartment. I like to call this the first time buyer's property. Here we've got a nice young couple. They're looking for their first investment property. They come across something like this and they think, oh, you know what, all property is a good investment, so I'm going to buy this property. But the reality is that this property, by Robert Kiyosaki's definition of asset versus liability, is a liability because it takes money out of their pockets. Now, although it looks very nice and beautiful on the inside here, you can see the kitchen, the bedrooms. I mean, this property is obviously very hip and very modern and beautiful. But the question is it an emotional asset or a financial asset? Now, those two are very key to differentiate from. An emotional asset is the holiday home that you have that brings you enormous joy and fulfillment for those few weeks of the year that you're there. But from a financial perspective, it's a liability because you're not renting it out, you're not making enough money to justify the expense. It's fine if it's an emotional asset, but don't call it an asset if it's taking money out of your pocket. A financial asset is one that purely from a financial standpoint brings in more income than there are expenses. So this would be an example of an emotional asset. It makes you happy, it's a nice home, you feel comfortable to be there, but from a financial perspective, you're losing money. Let me explain to you how this works. So this property is on the market for 3.8 million. That's a 75 square meter property for 3.8 million. Crazy. It's crazy. And the levies are 3,204 and the rates and taxes are 1,310. Crazy. So let's have a look at what the rent could be. So I use this tool called Pocket Let. It tells me that your average 2-bedroom, 2-bathroom property is probably going to generate about 21,000. Now maybe this property is in such good condition it might generate a bit more, it might generate a bit less, but let's assume that that's the average rental price. The last thing that I needed to do as part of my due diligence is to work out what the bond repayment would be. So just using Property 24's bond mortgage calculator, you see I've put in the purchase price, a deposit of 10% at 7% interest rate over 20 years. And on the top right, you can see that my monthly bond repayment on this property will be 26,500. Now, one of the things to note here is that your rent of 21,000 is not even going to cover the bond repayment, which is at 26,000. So your first inflow item of rent doesn't even cover one of your outflow expense items, being your bond. So this deal is not going to make cash flow positive sense, not at all. So if we break down the numbers, you've got rent, 21,000. You've got a bond, you've got levies, which are enormous, you've got your rates and taxes, you've got provisions, things like maintenance, vacancies, a management agent, those kind of things is what you would include there. I've just put there a 20% provision, so 20% of the rental will go towards vacancies, maintenance, and management. You're left with a negative cash flow of 14,229 Rand. So every month you have to take from your salary or your other incomes to afford this property. Now, if it's an emotional asset and you've justified it that living in this place is so great that it's worth 14,000 Rand, that's great. I have no problem with people spending money on things that will make them emotionally happy. But to call this a financial asset because it's a property is false, because it's taking money out of your pocket. Now, it might appreciate in capital. And then you've got an argument to say, you know what, I'm going to hold this property for 5 to 10 years, and maybe the appreciation is 10% per annum. So in 10 years' time, I'm going to sell it for 6 million, and it'll be an asset. That's a point that you could make, but remember that capital appreciation is speculation at best. Yes, the property might appreciate in value. The property also might depreciate, it might stand still. So what you're now doing is not necessarily investing, you're more gambling. So is it an asset? Maybe from an emotional point of view, yeah. But from a financial perspective, definitely not. Now let's look at a cash flow positive example. Okay. So here is a property that I had a look at. It's in Potchefstroom in the Northwest Province, a 2-bedroom apartment. And here we've got our savvy investor Sherry back in, and this is what I call the cha-ching type of investment. Okay. Now when you look inside here, it's obviously not as fancy or as pretty or as modern or whatever as the Greenpoint deal. But what we're looking for here is we're looking for an average house for an average person, right? 75% of the South African market that are renters can afford this property. Only about 1 or 2% can afford that Greenpoint property. So when you're looking for a property that you want to buy, hold, and rent out to tenants, the more tenants you have to rent out to, the better your business model, right? It's like if you want to sell jeans, but you only stock incredibly skinny jeans, that only fit one type of person, which is your hipsters. Now, if you're only targeting your hipsters, yes, maybe you can make a business. But if you've got jeans that cater for everybody, for people with all different types of body types, you're going to have more of a market to sell your product to. Same with property. You need to buy properties where you can rent out to the mass market. So here the property is being sold for 320,000. So that's less than 10% of what the Greenpoint property was selling for, and it's 100 square meters. It's even bigger than the Greenpoint property. That's crazy for me. Levies 986, rates and taxes 230. I again use the Pocket-Let app. It says 7,000 as rental. I then also did the monthly bond repayments. Based on a full asking price of 320, your bond repayment is 2,232. So the numbers on this one: 7,000 Rand rent, minus your bond, minus your levies, your rates and taxes, your provisions. Again, I've used a 20% estimate for management, vacancies, and maintenance. I think I said maintenance, vacancies, and management. You're left with a positive cash flow of 2,152 Rand. So the Greenpoint property is taking 14,000 Rand out of your pocket. The Potchefstroom property is bringing 2,100 Rand into your pocket. Now, I'm not saying that, guys, you need to avoid Greenpoint and go straight to Potch because that's where the deals are. No, it's not about necessarily the area. It's about the type of property you're going for. It's your lower to middle income areas, your 250 to 500,000 Rand sort of ballpark, or you're sort of working within that range. Your 250 to 500,000 Rand asking price, and your rent needs to be about 6,000 plus. That's where you're going to find your cash flow positive areas. You've got lots of those in Cape Town. You've got lots of those in the Eastern Cape and KZN and in Northwest. You obviously need to find them. Is this an asset? From a financial perspective, yes. From an emotional perspective, I mean, I guess if you're not living there, it probably doesn't have any emotional advantage, but this is a financial asset. Okay, so our property on the left is an asset in terms of the definition by Robert Kiyosaki, bringing money into your pocket. The right is a liability, is taking money out of your pockets.
Are you tired of having more month at the end of your money? It's time to venture into property investing. And although it may seem scary, don't worry. We've created tons of resources to help you get started. From tools that help you analyze deals, to online training courses, to one-on-one specialized coaching. Click the link in the comments below and get started today.